This week, the markets didn't just wobble, they snapped. All the data said boom, but the charts screamed panic. And the trigger? A sudden crisis of confidence that hit the AI sector like a shockwave and sent global markets into freefall. If you're new to finance, stay tuned. Our explainer starts right now. And for deeper insights, don't forget to check out our weekly market podcasts, available in French, German, Italian, and Spanish, now playing on our channel.
Well, this week, the global markets got a serious case of whiplash. I mean, all the economic news was absolutely glowing, pointing to a healthy, growing economy. But behind the scenes, something else was brewing. A sudden crisis of confidence in the white-hot AI sector triggered a massive sell-off, and it just erased gains and sent shockwaves all around the world. So let's break down what in the world just happened.
So on one hand, you had this incredible blockbuster earnings report from the king of AI, NVIDIA. The US jobs report, solid. Europe's economy, it looked surprisingly resilient. I mean, by all accounts, it should have been a fantastic week, but none of that mattered. The reality was markets tumbling, fear spiking, and the very AI stocks that have been driving this year's rally, well, they led the charge straight down. So what on earth happened here?
You know, it all really boils down to what we're calling the great AI sell-off. And this wasn't about bad data, not at all. This was about a fundamental psychological shift in how investors are now viewing the future of AI. It was a sudden crisis of confidence that just rippled through the entire global economy. The key concept you need to understand here is something called a valuation reset. So what does that even mean? Put simply, it's the moment the market as a whole just says, whoa, hold on a second, the hype has gotten way, way ahead of the actual profits. All of a sudden, investors decided that stock prices, especially in AI, had flown a little too close to the sun and needed a serious reality check.
And this quote right here, it gets to the absolute heart of the matter. This whole story was about psychology. The feeling that things were overvalued became more powerful than the hard facts that companies were actually doing really well. In this market, sentiment just completely steamrolled the fundamentals.
And you don't have to look any further than NVIDIA for the perfect, almost bizarre case study in this paradox. The company announced record-breaking revenue and gave a fantastic forecast for the next quarter. Logically, that stock should have soared, right? Instead, it finished the week down 3%. That's just how potent this wave of negative feeling really was. And you can literally put a number on this fear. 28. That's the level Wall Street's fear gauge, known as the VIX index, spiked to. Now, to put that in perspective for you, anything above 20 suggests investors are getting pretty anxious. A jump all the way to 28, that signals something much closer to acute, widespread panic.
So, how did this AI shockwave ripple across the globe? It certainly wasn't just a US problem. Let's take a quick tour of the turmoil, and we'll start at the epicenter of the sell-off.
Yep, the United States was ground zero. The tech-heavy Nasdaq, it took the biggest hit, dropping almost 3%. The crucial takeaway here is that even with strong data showing the creation of 119,000 new jobs, that anxiety around AI valuations was just too powerful, and it dragged everything else down with it. Now, this market anxiety had a really fascinating side effect on what people thought was going to happen with interest rates. See, at the start of the week, the market only saw about a 30% chance of the Federal Reserve cutting rates in December. The thinking was pretty simple. The economy seems strong, so why would they? But just look at this dramatic shift. By the end of the week, after some pretty dovish comments, which is just market speak for hints of a more supportive stance, from the New York Fed president, the market completely flipped. The odds of a rate cut suddenly surged to 72%. The fear of an AI-led slowdown became so real that investors started betting the Fed would have no choice but to step in and stimulate the economy.
Okay, let's hop over to Europe, where the story was pretty similar. The continent's own economic data was surprisingly good, with business activity actually expanding. But it just didn't matter. Good local news was no match for the negative wave coming from Wall Street. You know, they say when US tech sneezes, the world really does catch a cold.
Meanwhile, in Japan, we saw this incredible battle between government stimulus and investor skepticism. The government approved a massive, and I mean massive, 21.3 trillion yen package to boost the economy. But even that couldn't stop the Nikkei from falling nearly 3.5%. The global fear of a tech downturn just completely overshadowed this huge domestic effort. And finally, we have China, which was hit by a painful double whammy. It got slammed by the global AI sell-off just like everyone else, but that pain was compounded by its own severe multi-year property crisis. The result? A staggering 5% drop in Hong Kong's Hang Seng Index. And this really underscores the severity of the challenge for China. It is fighting a crisis on two fronts, with major structural problems in both the technology sector and the property sector, all at the exact same time. So that was the week that was. A lot of red ink. But what does it all mean for the days ahead? Let's look at the key risks on the horizon, because that's what really matters now. All right, here are the top 5 things the market is going to be watching like a hawk. First and foremost, does this AI valuation reset keep going? Does it get worse? Second, will those US rate cut odds swing wildly back again? Then over in Europe, the big question is whether a surprise inflation number could derail their current policy path. And of course, all eyes are on China's property crisis and whether Japan's stimulus plan puts even more pressure on its currency, the yen. And here's exactly where you should look for clues. In the US, we'll be watching the Producer Price Index, or PPI. That's basically inflation at the wholesale level, along with key inflation numbers from Germany, France, and Italy. And of course, any policy announcement out of Beijing on its property crisis could move markets in a huge way. The dollar-yen exchange rate is also one to watch. And here's one final piece of context for you. It's a holiday-shortened week in the US because of Thanksgiving. That means fewer traders are at their desks, a condition we call thin trading. In that kind of environment, any piece of news can cause bigger, more volatile swings in the market. So, buckle up. It could get bumpy. All of this leaves us with the big question. Was this week's sell-off just a temporary panic, a quick blip that we're all going to forget in a month, or are we witnessing a much more significant, permanent reality check for the entire age of AI? Honestly, the answer to that question is going to define the markets for the foreseeable future.
If you found this breakdown useful, hit like and share it. It helps more people discover MacroNav. And if you want more clear, no-nonsense explainers on global macro and finance, make sure you're subscribed. Stay ahead, stay informed.